Everybody, and welcome to this week's edition of Selfwealth Live, the Traders Edition. To be honest, Jason, I'm starting to reconsider this whole naming of our show. I think we'll have to revisit that. We'll call it Traders Edition for now. Quick funny story. How are you first, Jace? How are you this week?
Good. I'm all good up here in Sydney. Looking forward to another edition of talking about charts and ideas and possibilities and all of those interesting things.
And I'm pumped as well. So the story goes that I had a new starter at Selfwealth yesterday, and CEOs going around and introducing us. That gets to me, and this is Roger, and he's in charge of the sales team, relationship management, and he goes, he's also our top chartist, or our top. He loves charts. He loves top chartists. So I think, between you and I, Jason, I think you've made me some sort of a charting guru there at Selfwealth. I don't know, I guess that was a bit of the intention, but at the same time, that's what this show's all about. So yeah.
Well, you've done the yards around the charts. You do know your way around a chart, I think, better than most. So I think that's quite a fair call, calling you the chief tech guy at Selfwealth.
Yeah, I've done the yards. That's over the last 8 months with your help. Thanks, Jason. Welcome to all our viewers today. It's fantastic having you with us. Week in, week out, seeing same familiar people faces. I was about to say, but familiar names on the chat. It's so good to see people coming back. All right, and hopefully we get some newbies as well over these series. Jace, did you want to talk about our disclaimers?
Yes. Look, as always, everything today is general commentary only. There's no personal advice given. You need to go and get that stuff on your own if you feel you need it. Just quickly putting on our disclaimer, which again just says all that general advice only. It's got all the licensing details there. I'm part of Motion Trader. Motion Trader is my business. I'm not part of Selfwealth, but I come together with Rog every Tuesday and we talk about charts. And Selfwealth, you can see their licensing details there as well.
Okay, thanks. So, of course, always do your own research on anything that we talk about. All right, Jace. So today we're going to talk about a few things. First of all, update on the markets, and then we're going to talk about an ending question that came last week. Right, the topic of how do we measure up, how do we get the upside of our trade, and then we'll go up. We'll have a look at some of the charts, some of the tips that you may, or some of the stocks that you were looking at this week, and whatever the crowd has for us, right? So let's start off with the markets this week. Do you feel they're starting to slow down a little bit? They're still sitting there at their highs. What do you think?
Yeah. It's been a good week. Well, it's been a milestone week in the ASX 200 with a new all-time high. And actually, just call up a chart. It's always good to have a look at that sort of thing visually. So it's here we are. This is the ASX 200. So it was on Friday. We got the new all-time high. Actually, had a new all-time high on Wednesday. Brief pullback, then another new all-time high. And it's interesting thing, these all-time highs, because I think I'm just compressing this chart a little bit. You can see the previous markers back in 2021, 2022, this long 2-year grinding sideways period, which I think a lot of people have found quite a difficult time, because these sideways periods, you get fewer upward trends, you've got more stocks falling. It's just a difficult time, particularly when they go on for 2 years. And but look, we've got that new all-time high now, and they're interesting things in that people actually find new all-time highs. Well, a lot of people do anyway. A lot of people find them actually a little bit unnerving, because they think, oh no, look, the market's made an all-time high, so maybe it's a case that things are getting tired and it's coming close to an end. But the way the research and all this plays out is that new all-time highs often lead to more highs as the weeks and months pass. So this is sort of like a day-by-day thing. Like a new all-time high doesn't mean every day is going to be another high, but it's it's because of course we've always got those pullbacks along the way. You get a new high, you get a pullback, like you get a pullback, another run, and but the point being that all-time highs, it's one of those indicators that the overall trend, or what I'd call the path of least resistance, is to the upside. So that's a good thing. I think new all-time highs are something to be pleased about, I'm not saying to be fearful about. And so we look at the this current price action. And I think the question here, Roger, is like, are we going to see a sequence of new time highs, or are we going to get some consolidation? And my feeling, and this is something we've spoken about over the last couple of weeks, and I speak about in my Friday strategy session videos, which I do through Motion Trader, is that I'm just not sure that the ASX 200 has done enough consolidation for this big run we've had off the October lows. And we we've broken to a new high, but it's not really a decisive break at this time. I'll look at this chart, and prices are getting elevated above these moving averages. So this is a 50-day and the 100-day moving average. And the moving averages is something I think is a really important things for people to have a look at. They can just call them up on their own charts. And you look at an upward trend. So this is an upward trend from 2020. You can see the market runs, it comes back to the moving averages, runs back to the averages. And that's typically what happens. You can go back 10, 20, 30 years, whatever it may be. You get runs, you get pulled back to the averages. So looking at this run we've had off the October low, maybe it's getting close to one of those pullbacks to the averages. And another thing I look at, which makes me think that way, is I'm going to put on an indicator. I'm going to put on an RSI. So an RSI is a relative strength indicator. They can be useful for a lot of the time. I don't look at the RSI, but there are certain periods where they can be useful. So this is a 14-day RSI. And what's interesting here is the divergence, which you can see on this chart, in that we've got the ASX 200 making a new high above the high from December. It's made a new high in the last few days. Come down to the RSI, it hasn't reached its previous peak in December. So that's what we call divergence, negative divergence. Often when you see this, it can be a precursor to the market having some sort of a pause. So look, these RSIs, divergence, it's not the be all of end all. It's just one of those things that you pull together within a pool of things that you may look at as a potential influence. And don't get me wrong here, I'm not warning of a topping phase by any stretch, because as I was saying, new all-time highs are generally good, but it's just whether there's a pause in the price action coming up. And that would be interesting. A pause would potentially give us those points to add risk, add more stocks. My way of playing this is I've been long the market. I think being long the market is the play here. That's how I'm positioned. And as we've spoken about in previous weeks, I think the way to be positioned is to use those what we call trailing stops. So a trailing stop is an exit level which follows up beneath your trades, your investments, and that's your get out place. If the market does turn, it does pull back a long way, well, you've got to get out. But they're one of those things that can keep you in an uptrend for a long time. They can see off consolidation. So if the market were to chop for a bit, then turn higher, those trailing stops, they help you keep your upside open. I think that's a big advantage of the trailing stops, keeping the upside opened in the event the market runs, but then being able to manage risk on the downside.
Yeah, and I'm glad you brought up that RSI actually, because I had a client ask about that. Do you use it a lot? I mean, obviously there's a clear divergence, bearish divergent pattern happening between the two charts there. How often do you use it, and do you use it?
Yeah, look, not that I'll look at it a bit, but I don't really base too much off it most of the time. So see this section through here where it's just chopping around in the middle. I don't find much value in it there. Even when it's getting up to an overbought, what people would say is overbought. So where you got the dash line at the top and oversold the dash line at the bottom. I also don't get too bothered by that. I could buy a stock which would have a seemingly overbought RSI, because stocks can stay overbought for some time. So, like if you were looking at this period from 2020, the market was seemingly overbought, but it kept rising. It's and divergence isn't magic either, because you could also see this period through here. The market was generally going up, but the RSI was coming off, so that was giving a signal to be maybe a little bit wary. But using those trailing stops, it's you can say, look, I'm cautious because I can see the RSI is coming off, the market's rising. Is there some divergence there? But rather than say, okay, well, I'm just getting out, I'm going to call this a top. It's like, well, okay, I'm going to make sure I manage my risk. I've got my trailing stop loss in place, which is traveling up beneath the market. But as long as that's not triggered, I can stay long. So that's how I'm using the RSI. It's it can be useful. Look, it was useful at this point in just before the COVID crash. Market made a new high. The RSI didn't. So it didn't predict COVID. It wasn't predicting we were going to get the sell-off that we got, but it was suggesting maybe there was reason to be a little bit cautious. Maybe the market was setting up for some sort of a pause because it had a bit of a run. And well, as history shows, we got more than a pause, but the RSI gave a warning to be just a little bit wary. So that's how I use it. It's not a predictor of big things to come, just of when. Make sure you got your risk management in place, and maybe think twice about adding a whole lot of risk when you're getting that negative divergence creeping in.
Do you mind just drawing a couple of lines, just for the people that don't know what they're looking at? Do you mind just drawing a couple of lines from on the price chart and then on the oscillator there, what we're looking at here?
Yeah.
So you can see obviously there's there's higher highs on the price chart, but then on the it's lower highs on the oscillator on the RSI, right? So that's the divergence going on there. So
it's so look, not the be all of end all, but it can be useful. Like it was useful around these lows. I'm just scanning back as we're speaking. You can see the RSI stopped making new lows, whereas price was making new lows. It was a sign that maybe that market was becoming stretched and oversold and due for a rebound, which is what ultimately happened. But it doesn't show up all the time, and sometimes the divergence disappears because the market keeps going up and the RSI eventually catches up. So it's there's no holy grail indicators which work every time and give you certain signals, but there are times when they can be useful to just be aware of.
Yeah, no, but I like it. At least when you see it starting to happen, for me, it's at least, if I was to look at that, it's being on guard more so than what you would if there was no divergence, right? And being on guard and ready to action, your stop losses should anything happen like that massive fall over in COVID, right? So
yeah, that's right.
Okay, fair enough. Let's have a look at the US market. What are they looking like?
Yeah, well, another new all-time high for the S&P 500. Couple of things I want to discuss with this, and the first one is that I think this is a market we want to be long, and that's been the case. Well, that was the case. That's been the case much of the time since we got the low back in October 2022. But then also from when we got this false breakdown in last October, market broke to new lows. Looked like it could have continued lower, but then we got that quick reversal up. So that was another sign that we wanted to be long this market and to continue adding to stocks as they were breaking upwards. I've got the ASX there. So so there's the false break in the S&P 500. And then we got the rally, got back above the moving averages. So this is a market that we wanted to be long, I think, for some time. The price action has justified that. And I think the play is to, just as I was talking about in the ASX 200, it's staying long, but using those trailing stops and giving your stocks room to move around. And that's an important point. You've got to give them room to see off consolidations in the market. And I think that's the best way to keep that upside open while managing the risk. But then the other thing is, like, what do you do if you're not long? What if you're looking at this for the first time? You've been out of the market because you've been concerned about people talking about recessions and interest rates, and that's sort of like put you off the market, and you're looking at it now going, well, look, those bad things didn't happen. What do I do now? And should I just get in? And I think that, look, for the last few weeks, I've been talking about this probably not being an asymmetric entry point for the S&P 500. So when I say asymmetric, I'm looking at, like, I'm thinking about, what's my downside risk maybe in the near term versus what's my upside potential. I'm just trying to weigh it. I'm going to talk a bit more about this later on. And when I do that, it just doesn't seem like like an optimal buying point. Like I said earlier, the new all-time highs are a good thing, and that's true. But then also new all-time highs have pullbacks, they have consolidations. And so my concern with the S&P 500 is it's had a big run off this October low. It is pulling away from those moving averages. And I think some sort of a near-term pullback, maybe back towards the average, it's a distinct possibility. It's not a certainty by any stretch, but it's a possibility. And another thing I want to do, Rog, which I think is quite interesting, I want to talk about psychological factors, which is something we don't always hear about. And I'm going to go on a weekly chart for this.
To do with Trump, psychological factors to do with Trump is quite in the news a lot at the moment. So
there are all sorts of psychological factors, but I'll stick to the chart psychologicals rather than the external ones.
Yeah.
And so if anyone who watched my strategy session last week, you already know where I'm going with this. But for those who don't, what happens around markets could be individual stocks or it could be indices. There's a tendency for markets to pause around big round numbers. So it could be in a stock, it could be $1, or it could be $10, it could be $100. Might have seen on the news a couple of years ago when I think it was CBA was hitting $100 for the first time. That was a news event. So what? $100 is no different really to 99 or 101, but it apparently was a news event because it was $100, a round number, psychological. So what I'm going to do with this, I'm going to look at the S&P. I want you to focus in on 1,000, 2,000, and so on. So I'm just going to mark them up on the chart first, and then we can talk about them. So just take me a moment just to run through and find the levels. And they're not going to be precise because I'm doing this pretty quickly, but they're going to be pretty close. And we're going to look at what happens when the market reaches some of these key points. And now let's also put in the big level coming up, of course, is 5,000, which we're very close to now. So let's just draw that in. Now let's duck over to the left-hand side first, and let me just rescale the chart. Okay, so 1,000. I made that a little bit high. I think that's probably about 1,000 there. Yeah, so you can see what happened when the S&P first got to 1,000. That was 978, 980 thereabouts. So just below 1,000. Had a big rally. Market paused below 1,000 before breaking through. Now we move on to the next. It doesn't remain a key level forever. It's just when the market gets to these key psychological points for the first time, there tends to be some hesitation before going through. Now we're going for the next point. It's 2,000. First time the S&P got to 2,000. Again, you can see it pauses. There's some volatility around that level. Then the market marches higher. Go to 3,000. We've got something similar happens. Market's pausing around this 3,000 mark, pulling back. Then it runs through it again. 4,000 again. We've got a bit of a pause around that point. And remember, this is a weekly chart as well. Put it onto a daily chart, and these pauses can last a little bit longer. Yeah. So they're just looking at the most recent one on a daily chart. So you can see there's a few weeks of messing around before it gets through. And now we're up at 5,000. So what's going to happen this time? Will we follow that pattern we've seen in the past, or will it just charge through? my feeling is when you bring it all together, you look at RSIs, you look at the length of the rally from the October low, you look at the distance above the moving average. We've got a round level, a big psychological number. I think there's a reasonable case to say the market could pause around here. So this is why I'd say maybe not the ideal time to be piling on a whole lot of new risk. I certainly want to continue to hold stocks. I'm not calling a major top by any stretch, but that's what my trailing stops are for. If there were a major top, my trailing stops get me out. But this may not pause, or it may pause briefly, and the trailing stops keep you in those positions. But yeah, it's one of those interesting things, like Dow 1000, Dow 10,000. You hear it from time to time around these big levels, and one of those things I think to watch.
And do you actually look at the other major indices in America as well, or you just look at the S&P 500?
No. They can all give you clues as well. When you get the S&P making a new high, but the Nasdaq's lagging, or the Dow's running, but the S&P's stalled, or the equal weight's not doing anything. It all plays into this, like giving you clues on market breadth, divergence between indices. It can all help. There's a lot of things you look at, and you really it's a big mixing pot of things, and you're all these influences, and we're looking for clues from these influences to help us understand what our possibilities going forward look like.
Yeah, fair enough. All right. What does the Hong Kong market look like? Is that recovering at all? Or?
Yeah, not really. Look, there's probably not much to say here. The downtrend remains in place. For me, there's just probably not much to do here at the moment. From a short-term perspective, it's interesting to see there's been that strong rally off the low, and this sort of choppy overlapping decline. So just having a look on a 60-minute chart, for people who like to bring things shorter term, it's interesting that you could say, look, that's an impulsive rally off the low, and then maybe we've got some sort of a flagging position forming on the like the hourly charts, and then from that you go, well, look, okay, there's potential for this to have another rally. But when you bring that back to a daily chart, it's like, well, look, maybe it's a rally just back to the moving averages. It's nowhere near enough to say, look, this is a potential base. There are a couple of other interesting things we won't go through today when you look at RSIs and such, but that starts to strain into the realm of trying to pick a low, and that's a really difficult game. I'd rather wait for the Hang Seng, when it bottoms, it really can rally quite quickly, but still picking the low is a pretty tough game to play. I'd from an investment perspective, I think it's too early to be looking for a lasting low in the Hang Seng.
Yeah, fair enough. And did we see a divergence on that S&P 500? Was it the same as the Aussie chart, or was that different?
Yeah, it's similar. There is some divergence playing out in the S&P as well. So I can just quickly show you. It takes a moment. You can see the S&P is making a new high, but the RSI hasn't yet made a new high. It's So look, there is some divergence at play there as well.
Okay. Got Kirby saying there's a lovely cup and handle breakout on that S&P. Can you spot that cup and handle breakout?
Yeah, you could be calling it. You could say, there's the cup, and then there's your handle there. It's a really classic charting pattern. It's you could also call it another name for it as a rounding formation. Often you get them after big declines. This is look, that was a big decline, but you sort of get it more like where the market's. I won't try finding one now. But rounding bottom, or a cup and handle being the handle, then you get the breakout and it continues upwards. So I think that's a default position in US equities at the moment, is that we have an uptrend in place, and we should run with that uptrend rather than try and find reasons for why it shouldn't be happening and why it should stop, which a lot of people spend a lot of time doing. And it's been the case ever since I got into the markets. People are always looking for reasons for the markets to reverse. And most of the time, they continue in their default direction for an extended run, whether it be to the upside mostly or to the downside during some of the big corrections.
Yeah. All right. Fair enough. All right. Let's get on to the topic of the day then. Jay, so I just want to know, one of the questions we had last week is, how do you think about upside potential? I think it was actually Talwyn that asked this question. There's another question off the back of this and off our RSI discussion we've got here as well, right? So, is it by reaching new highs, or is it going back in history? How do you think about that upside potential?
Look, it's a really interesting one, because there are two key components to every trade. When I say trade, I do trade/investment, because I consider myself an active investor, not a trader. Trader is often considered a day trader, but that's not. Trader can stretch over so many different time frames. So I'm looking for stocks that could run for 1 to 2 years, but I'm active in my approach. So I think there are two key components. So the first one is risk. It's like looking at what's my downside, and it's funny. A lot of people really don't pay that much attention to this first component. They'll jump straight to what's my upside potential. But I think the starting point is always, what's my downside? What can I lose? What could go wrong if, to my account, if this trade doesn't work out? But for a lot of people, it's an afterthought, and I think that's a mistake. And so once you work out, okay, this is my possible downside. Well, your downside is often pretty clear, because you can calculate it. You can go, okay, if the stock falls 10% or 15 or 20 or 25%, whatever it may be, I can have a clear-cut calculation, or I might use a support level, break. If it falls back, breaks below a previous low or breaks a support, that's my exit point. So it's quite clear to define. Then you think, okay, what's my upside potential? And this is a little bit harder to define, because we can't see into the future. We don't know where the stock will go to. It may not go very far. It may go a very long way, but we don't know. So we've got to work out. We've really got to consider reasonable possibilities as to where a stock could go. So probably good to use a chart to sort of go through a bit of an example of this. So I'm going to call up a stock. So this is stock Superloop. I'm using this one because it produced a motion trader signal recently. We're talking about rounding bases just recently with the S&P 500, and there, just quickly, there's an example of a potential rounding base where the stock could continue upward from. So just a little side point. So I'll look at a stock like Superloop. So got a buy signal on the 24th of January. So just breaking down this buy signal. Why is it a buy signal? Well, the moving averages have crossed. So 50 days above the 100. So that's step one. This is my primary indicator, the 1500-day moving averages. They're not special numbers. You could use 40 and 80 days, or 50 and 120 days, but 50 and 100 I find work well for medium-term approaches. You can use 10 and 20 days, but you just get a whole lot more signals. So 50 and 100 work for me. So the moving averages have crossed, and prices closed at a 70-day high. You could look at this period where the moving averages cross and go, oh, well, look, did you get a signal there? And this time didn't produce a signal, because the stock never closed at a 70-day high. So that 70-day high rule is a secondary filter after the moving averages, which help give confirmation to is a trend more likely to continue or not. And if you don't get that 70-day high, you just let it pass through. And in this case, it didn't. It price pulled back. It wasn't quite ready. But now we've got the double green light. Moving averages cross, price at a 70-day high. Compress this back a little bit, and we can see it's come from a long way. So this is a potential turnaround situation. Sometimes you get rallies which are extending, other times you get turnaround situations. That's what this one is. So let's think about the downside. Where could you place an exit stop? Well, some obvious levels are we've got a previous low. We could use that. Another previous low. We could use that. We could use the moving close below the moving averages, which is pretty much using this previous low. So we can include the moving averages with this previous low, or you start looking at lows which are further away. There's no single best exit point. It's all going to vary depending on how you want to play things. Just measuring these out. So from the hypothetical entry, that's like possibly a 7% exit. Maybe it's 12%. Maybe it's around 20%. The motion trader stop loss is just below these previous lows, which takes to around 25%. So it's a little bit lower. The reason for that is it just helps see off consolidations when often a stock will break high and then do some work before continuing on. But there are different layers where you can place these stops. So now I can define my downside. I go, look, what's my potential upside? So I'll look at the chart. I'll look at a chart like this and say, well, look where this stock's come from. Let's look at it on a weekly chart, get a bit more data. Look where it's come from. Is it reasonable to say, could it get back to this high from November 21? We've got signs that the trend could be turning up. If it were to get back to there, well, that's a 90% run. So I say, look, I'm risking somewhere between 10 and 25%. I could possibly make 91%. That's a reasonable, I think it's a reasonable possibility should this trend run. And then there's always a possibility that it becomes a super trend and it continues much higher. So from that perspective, I can say, look, based on my risk, based on my possible reward, this would stack up as a stock which I could consider. And I think an important part of this is to remember where I'm saying a reasonable possibility. Like, you just can't look at a stock and just say, oh, well, look, I think it can go from $1 to $10. It's like, why do you think that? It's like, for me, I'm using the moving averages. It's a big part of it. I'm looking for stocks which are above the moving averages and making new highs. So that's the underlying basis of me being able to say, look, could this stock continue back up to a previous significant peak, which is maybe 50 or 60 or 70 or more percent away. For example, I don't think it'd be reasonable to get a stock like, say AGL. Let's use AGL as an example. I don't think it'd be reasonable to look at a stock like AGL, which is currently making new lows, and say, well, look, if I buy it here, I think it can go back up to its previous high. Well, at the moment, the path of least resistance is down. The stock's making new lows. It's got declining moving averages. I don't think it's reasonable to say, if I buy it here and use a 5% stop loss, it could rally back to $12. Yes, it could, but I don't think probability favours that. I think you're sort of like going against the odds. So we really want the odds to be on our favour. So that's why we're looking for stocks. I'm making those reasonable possibilities based off stocks which are already trending higher. I think value investors would probably have a different perspective on this. They might say, look, this stock's now cheap. Maybe they wouldn't, I don't know. But they'll typically look at a stock which is falling and go, look, this stock is trading below its fair value. And that's fine. That's a different process. There's nothing at all wrong with doing that. But even a good value investor, Roger, I think even a good value investor, they've got to still be able to assess risk and go, well, okay, what if I'm wrong? What if it keeps falling? Am I going to keep riding it all the way down? I don't think you can just look at that potential upside. And that's what we were saying at the beginning about, what's your risk? And I tell you an interesting story. I was talking to a really good trend following trader who I've known for years last week, and he's telling you about this deep value deep value investor, and he bought this stock for $1.50, thinking it had really great value proposition, trading below breakup value, all this sort of stuff, and he ended up selling it for 5 cents. So it's like, you've got to be able to assess, like, what's my downside risk? I don't know that writing it from $1.50 to 5 cents, no matter how much perceived value is there, is a reasonable proposition. Like, how do you justify torching 99% of your capital, no matter how compelling the value situation is? So this is why I say it's always important to go, well, look, okay, I could be wrong. I think this is a standout trade because it's breaking higher, or the sum of the parts of the company is less than the current market capitalization. All this is well and good, but what if I'm wrong? And this is where I think it's important to be able to put ego to the side and have these calculated levels where you say, okay, market disagrees with me. I can't argue anymore. I've got to protect capital. Got to get out. Selling for a 99% loss. It shouldn't happen. It's a completely avoidable situation.
Yeah, well, it's much easier to sell at a loss than stomach the heartache. Sell at a smaller loss on the way down than sell the heartache of selling right at the bottom of the trade, isn't it? So I think you're absolutely right in having that strategy on the downside. So you've sort of showed us, and it sort of confirms that we've used historical highs. We can use historical highs to sort of work out your upside, right? What about, do you use profit targets at all? Profit?
Yeah, I think, Rog, I think the best profit target is to have no profit target. So I approach every trade with optimism that this could be the next big trend. This could be the next trend that runs 100%, 200%, and so on. And we're looking inside my portfolio a few weeks ago, and I've currently got, I think, six stocks which are up over 100%, and I've held them through a period of time which has been a little bit unnerving at times. If we can remember the last 12 months, and these stocks have been in the portfolio for much of that 12 months. But I've kept the optimism that, well, these stocks could keep going up, and they have. And at some point they'll stop and they'll come down, and that's all fine. But where they stop, I don't know. Will they stop at 100%? Will they go to 2, 3, 4, 500%? I've had that happen in the past. So it's just having that optimism that things can keep running. So this is why I don't use profit targets. I think profit targets can... What I don't like about profit targets is that they cap your potential. They limit how far a stock can run and how much money you can make. And I think we make the most money when we let our best trades run. If something's working, don't short circuit it by leaving the party. Let it keep working. It's when things aren't working that we need to really be diligent in jumping out. But when something's working, let it work. So this is why I don't really like profit targets. And it's interesting, and this is something I've seen for years and years and years. I'll see broker reports or fund managers, and they'll talk about fair value. And so, say a stock's trading at a dollar, and the broker report might say fair value is $1.20. It's like, okay, well, it's trading at a discount, so there's 20% there. Maybe it's worth buying. What happens when it gets to $1.20? It's like, well, then you go, okay, well, it's fair value, so that was my basis for buying, so now I better go and sell it. I made 20%. It's like, well, how do you get these big gains when you're banking these profits based on fair value? And that's assuming that the report is right and the stock goes up. Often they're not right and the stock goes down. It's hard. No one gets these things right all the time. When you are right, I think you want to try and be very right and not jump off early. And I think what the market's doing, the market is pricing in the future. So yeah, it might be fair value today, but the market's pricing in what it thinks the stock's going to be worth tomorrow and next week and next month and so on. That's what markets do. And so this is how trends develop, because the market keeps looking ahead, and this is where you can make a lot of money by staying on those trends. I think Yeah. Look, I think we benefit from the future potential of the stock by really thinking twice about those profit targets. It's interesting. I did a because one of the things I often hear people talk about, and I see written online, people be talking about all sorts of commentators online writing stuff, and popular strategy is to sell half when they get to when the trade's going to be at break even, so they can say that the stock's up 25%, and their initial risk was 25%. So they say, look, let's sell half, and now we've got a free trade. We can't lose anything, because if the other half falls back to its stop loss, we get out at even. So this is a no-brainer. Let's go free trade. And this is something I tried early in my career, because initially it does sound kind of appealing. A free trade, that's pretty good. But there's the problem with this is that what you're doing when you take profit at, say, 25% or 20% or 10% or something like that, you're diluting what could be your best trade of the year. Whereas when you get a stock that you buy and it doesn't work at all, it falls immediately, that stays at full strength. So your worst trades stay at full strength, but your best trade, you're running it at half strength. So I did. I'll show you some research I did. Just briefly show you this. So this is one of the mentoring reports I do each week in my motion trader service. So I've got my weekly mentoring session. I do a report, and I'm just going to go down to the archives. So I've got all the weekly archives. It's beware of this profit reduction strategy. And so I actually backtest that very strategy I was just telling you about a moment ago. So let me just come down to it. So what I did...
Are you meant to be sharing the screen now, or are you just reading off it?
Thank you for telling me that. There we go. Yeah, I do that sometimes. This is the danger of flicking between screens. You forget which screen which you're currently showing. So this is what I was just saying a moment ago. Weekly mentoring sessions. I do these each week for the Motion Trader members, just talking about, like we're doing now, just talking about like the whole process. And just going down in the archive, because I'm going back a few weeks. I do these every week. So beware of this profit reduction strategy. Come into this. Now, we won't worry about all the intro to it all, but what I want to do, what I did here, selling half when profits were equal. What did I? Sell half the position once the stock rises by 25%. So Motion Trader's initial stop loss is somewhere around 25%. So it's based on the stock's volatility and so on. So based on that strategy we were just talking about, let's sell half when we're up 25%. And then we'll let the rest run. It's basically a free trade. Can't lose. So the theory goes. So, and this is a great thing when you have a rules-based process, because you can actually go back and test it over time. Like, how did this work? You don't need to guess, oh, look, what do I think it might do? You can go, look, how would it have actually performed in real-life situations? So I tested this strategy going back to 2009. So you can see so this is taking every trade which meets the entry criteria, letting profits run, it's cutting losses, it's using a trailing stop loss. The only difference between the strategies is that this lower one is selling half at a 25% profit. So it still does very well over time. It just doesn't do as well. So this is the thing. This is why I like to, when I'm in a stock and a stock's working, I want it to work to its fullest extent.
Fair enough. It's a good example there. So yeah, look, the message I think there as well, once again, is there's not just profit targets. It comes to risk reward. You always hear people doing potentially a 2-to-1 risk reward, or it might be a percentage. Just so if you have a percentage for a stop loss, you'd have a percentage there. Just let the thing run until it hits your stop loss on the upside, versus having a cap target there, right? So that's the message you're sort of trying to get there, which is it's a good one to have, right? And I'm really trying to stick to that as well myself.
So with the trailing stop loss, and this is a part of a trailing stop loss a lot of people don't like, because they never sell at the high. They always give back profit at the end. because the stop loss the trailing stop will rise with the share price, and then the share price will peak and will come back and will trigger the stop loss, and you might give back 20-30% of your gain. But what's the alternative? The alternative is you've got to try and pick where it's going to peak, and that's impossible. Really, do that consistently. It is one of the impossibilities because no one has ever done it, predicted the peak in every single stock they've been in. It doesn't happen. So what ordinarily will tend to happen over time is that you'll get out too early on your best trades. Yes, some you'll get out and you go, well, I'm glad I got out of that. But there'll be others you'll get out. And I've had people tell me they'll get out at thinking they're really clever getting out at 30% and it goes up 300%. And they're kicking themselves saying, what did I do that for? They had to risk giving back a part of that gain as the ticket for entry to having the potential of staying on that really big trend. And the big trends do happen, not every time, but you catch them by being willing to give back a portion of the gain. That's, as I say, that's the price of entry.
Yeah. All right. So now we've got onto this topic. There's a few questions here around stop losses. Let's talk about it. But before we get onto that, there's just actually one question here about the RSIs again. Do you reference stochastics ever? I mean, obviously it's quite a loaded question. Are the RSI and stochastic overbought, oversold indicators calculated using the same methodology? And do you reference stochastic ever? That's the question.
No, I don't look at the stochastics. I've got no problem with them. I'm not sure on the exact calculation. I used to look at them years ago, years and years back in the 90s. But there are so many indicators to choose from. And so I just like to narrow it down. I like to keep it simple. If you look at too many things, you'll get too many conflicting signals. And if you like stochastics, use stochastics and don't worry about RSIs. And if you like Bollinger Bands, do that and don't look at moving averages. And just find a relatively small group of go-to indicators and get good at assessing them rather than trying to use. You look at what's available on TradingView. It's like it's countless. And you can have layer upon layer of indicator underneath your charts. And it's like and I see it. I see people doing these YouTube videos, and they have lines. They have so many lines on the chart. I get it camouflages the price action. You don't know where the price is because there'll be like 5 or 6 moving averages. They'll have Fibonacci's with 8 different points. It's like, how do you do anything on this? They make something which should be so simple, so complicated. And whether it's to make themselves seem clever because they're dealing with a multitude of stuff, I don't know, maybe. But the best processes I've always found are typically the simplest ones. So you don't need a million indicators, and you don't need to clutter up your charts with thousands of lines. Just put a few key things and a bit of consistency, a bit of discipline. Know your exit points, get your risk reward right. Maybe 3 to 1's a good yardstick to use. But of course, we don't know what the actual figure for the upside is going to be. So it's just an estimate. So going with as we're talking about stocks which are rising. That's where the path of least resistance is up. So we can sort of project and go, look, is it reasonable to think this stock could run 3 times my estimated risk? And you play it like that. Don't need to go crazy.
Yeah. If you're looking at a new stock entry point, are you more cautious if the RSI is at the top or diverging, or do you just remain focused on the EMA and breakout? I guess you've sort of just answered that, but do you look at?
Well, I do. I just look at the EMA and or the moving average. That is, EMA is the exponential moving average, and the breakout. I actually don't do an RSI cross check. If the stock is, because I probably intuitively it comes to me now where the RSI is going to be. Maybe it plays a part in my subconscious thinking on a situation. If a stock is stretched above its moving averages, and I just naturally become hesitant. Might be making new highs, but it's stretched, so I think the path of least resistance is up, but I become wary of the potential for pullback to the moving averages. So I'll tend to be a little bit more cautious rather than calling up an RSI and saying, oh, look, the RSI is at 80. RSIs can stay locked at 80 for months, and the stock goes another triple-digit percent. So I don't get hung up on the moving averages, and unless I'm seeing really standout divergence on the top side or the bottom side. But as I said, I usually don't look at it in stocks. It's mainly the indices where I'll call that up.
Okay, all right, fantastic. I'm going to have two questions here based off the trailing stop. We'll sort of put them together because I think they're relevant anyway. So with your strategy for trailing stops, do you give more or less a berth for illiquid stocks? That's the first question, but maybe you can answer this together because I think they're related. If your stock continues to rise, do you then adjust your trailing stop? So is there any difference between, illiquid stock versus liquid stocks? And then obviously you would adjust it if it's rising.
Yeah. Well, the trailing stop will work off a stock's volatility. So it doesn't work, not the way I program. You can program in anything you want, but my ones, I can move it from stock to stock, and it's going to use the stock's volatility or trading ranges as the key component for calculating the width of the stock. Now, some of these low liquidity stocks, sometimes their price ranges are really, really narrow because they don't trade very much, and that can cause some issues with the trailing stop at times. So I also use because it make the trailing stop coming really close because it's measuring there's no volatility in this stock simply because it doesn't trade very often during the day because it's low liquidity. So I use I also incorporate a minimum percentage, so a minimum width of 25%. So much of the time I'm using the stock's width and a multiple. I use a multiple of 10, and then combine that with 25%. Use whichever is greatest. But look, those low liquidity stocks can be tricky at times. In terms of, do I tighten the trailing stop as the stock's running? And it's like, this is a question I do get asked from time to time, and my response is like, so let's say a stock's up. We'll use 100%. Say a stock's up 100%. Someone's thinking, look, I don't want to give this back. I understand the principle that I should let my profits run, so I don't want to take profits, but should I tighten my stop up? So it's just so I give back less if the stock turns. And my response is, what's got you to this point so far? Has it been using a tight stop or a wide stop? And that kind of answers the question, because you look and then you say, okay, go back and look at the share price action from where you got into up 100%. How many double-digit pullbacks have there been along the way? And invariably, there've been several. There could be between 10 and 30%. There could be 3, 4, could be more. Quite typical. And so, had you been using a 10% trail or a 15% trail for that, you wouldn't be up 100%. You'd be up, 20%, 30%. You would have been stopped out. So why does the situation change now? We're up 100%, because this stock could double again, and then it could double from there. But if it doubles again and you tighten your stop at up 100%, you're probably not going to be there if it's up 200% or more, because those pullbacks, that's what they're there. Pullbacks are there to shake you out, and they shake a lot of people out. So it's this what makes this hard. So many people lead us to believe this is easy, but it's not. It's simple, but simple doesn't mean easy, because you got to mentally think through, how does this all work out? And I can't make all this money without having risk. But I want to shut down risk. But if I shut down risk, I also shut down much of my potential for gain. So it's it's not handed to us on a platter. Where we need to work. We need to work to make our money in the stock market. That's how the game's played. If you don't like volatility, well then you got the property market, because your house doesn't get revalued every day. So it's different. But for those of us who like the challenge of the stock market and are fascinated by all the moving parts, these are the things that we need to accept and find ways to manage.
Yeah, and I think we might put a link to one of the sessions we did on trailing stops, right? And because you show how to use the ATR to measure volatility and things like that. So we might put a link under this because it's always a good reminder to how to use the ATR for volatility. 25% is generally easy to calculate for stocks, even as they're moving up, right? But volatility is a bit harder to measure. But there's an indicator for it, right? So it's not that hard to measure. All right. Yeah, let's go have a look at some quick tips here, some quick stocks from the audience. I know you had one, but do you want to have a look at ALU and WTC? What's the downside and upside potential for ALU and WTC?
Okay, let's go check them out. So ALU. So this triggered another motion trader signal this week. And that's often the case with stocks which keep breaking to highs, new highs. There's going to be new signals are going to come in. It's buying stuff which is working, not buying stuff which is falling. Working out the risk with this one, the risk always is that the stock pulls back to the moving averages, and that can happen any time. It's not inconceivable that a stock like this could form that sort of price action where it does come back, the moving averages start to catch up. This is complete guesswork. I don't know what it's going to do, but this is sort of price action which you often see. So it does. Say it were to pause now, it could pull back into this moving average range, and then it could rally off them again. Kind of did something like that back in October. Again, something like that back in January. It was there's probably more what I've just drawn in, what we saw back in a period during 2002 where it rallied and then had that pullback and then rallied off it again. So that's the risk. So I'm trying to work out, okay, where's the risk if I buy it now? Well, I've got to be prepared for the pullback to the averages. So we're assuming it probably doesn't come back in a straight line, so the average is going to keep rising. A tight stop on this. Well, you look at this previous low. There's a previous low point back in late January. That's around 7% away, and then you kind of get below the 50-day moving average. So look, someone could have a go at this with maybe a 10% stop loss. It could be more aggressive, but the more aggressive you are, the more likely it is that you get stopped out on the noise. The motion trader stop is going to be further back because it's using the multiple of the trading ranges, and that's how it stays on these larger trends. But for me, my thinking at the moment would be when is it going to revisit the moving averages, and how much room do I need to give it? I'd say for me, I'd be looking at a minimum of 10% to jump on this stock at the moment.
What about the upside? How would you look at the upside considering our topic today?
It's at all-time highs. All-time highs all-time highs are interesting. And interesting thing with all-time highs is there's no one above you to sell. So everyone who owned the stock at the high a couple of days ago, except those who bought at the actual high, everyone is in profit. So the only people selling are really people who are taking profit. So at all-time highs, there's no new supply to come onto the market from people who had bought 6 months ago or a year ago or 2 years ago and didn't want to accept a loss and said, I'll sell when I get back to even. So you got no overhead resistance at all-time highs. And you don't know. This is where I say be optimistic as to where a trend can go. There's nothing to say a stock like this can't double and double again. It's not to say that it will. It probably won't, I guess. It's like, most stocks don't double and double again before they have some sort of a big pullback, but it's possible. There's big trends often go further and last longer than most people conceive possible. So from that perspective, There could be a lot more to come in Ultram. But yeah, as always, you just got to manage your risk around it. You can work out where an exit point is, and your upside, you just say is open ended.
Yeah, and is there upside on WTC? Is it a clear upside, or is it just an all-time high as well? If we just stick to the upside at this point with the
double T. Yeah, well, look, your first target is the all-time high from August last year. But yeah, look, upside. There's there's nothing suggesting this stock can't run a considerable distance. It's above the moving averages. The moving averages rises in an upward trend. We don't know how far the trend could go, but it's reasonable to say it could go a long distance from now. It could go far enough to justify the risk of where a potential exit stop could be now. So you can say there is an asymmetric argument for buying WiseTech around current levels. Now that doesn't mean it's going to be a profitable trade. It just means you're putting yourself in a situation where the criteria for a profitable trade is reasonably met. Buying a stock within a downtrend, and you just build a portfolio of stocks and downtrends, going, I'm trying to pick the low. That's probably not building a reasonable case for a portfolio which could do really well in the months ahead.
Okay. What about FMG?
Fortescue. Look, it's had a big run off the September low. It briefly pulled back towards the moving averages. All-time highs. It's look, if I'm in this stock, I'm staying in it. I'm letting my profits run. It's currently pulling back towards the averages, so I'm probably not buying it today. If I was considering buying it, I'd probably want to see how it trades over the next few weeks. Like, is it going to consolidate and get one of those sideways consolidation after getting above the moving averages, goes sideways for a while and then starts to turn higher? What's it going to do? For me, it's not a buy today. It is pulling back towards the averages, but if I've got it, I'm holding it with that trailing stop. I'm letting this trend run for as long as I can.
Yeah, fantastic. We'll do one more, and that's NCK, and then I'll just get some general thoughts from you afterwards from the question.
NCK, so a good update. So look, this is a stock making a 52-week high, and it's the thinking, as we were talking about with the ASX 200. Well, the ASX 200 is making all-time high. This is making a 1-year high, but often people would say, look, a stock at a 1-year high, it's had its run. I don't want to buy it. I want to buy a stock at a 1-year low and get the turnaround. But the way things would be, it's often better buying the stock at the 1-year high, because that's the stock which is in the upward trend. You can see the moving averages have been positive for a number of months. The price has generally been rising, hitting those new highs now. There's nothing to suggest this stock can't go on and make a new all-time high. The path of least resistance is to the upside, and there are clear points here where you can manage risk and let this trend run. I'm pretty sure this would be a motion trader stock as well. So it's that same situation where the moving averages are positive, it's breaking to highs. We're getting long stocks. We're getting long stocks with momentum, and we're seeing where that momentum will run to.
Fantastic. All right. I think we will leave it at that. There's a question here. I know just your general thoughts, I think, with this one. Jason, probably don't need to look at charts, but I think, with the evolution of electric vehicles, things like, nickel and cobalt and lithium stocks, it's inevitable that eventually they're going to be rising, right? Now they've gone a bit stagnant. What's your thoughts on around it all? Should we having a closer eye on these stocks, or?
Yeah, look, it all makes good sense, but you just need to wait for the price action to agree with the view.
Yeah.
It's like I've seen things online, people screaming, saying, "Core lithium, these idiots don't get it. They're selling the stock. It should be 10 times this because their deposit's going to be worth this amount when all these electric vehicles are made." Well, okay, maybe, but at the moment it's down. I don't know what it's down, 80% or something like that. It's down a lot. And lithium prices down, nickel prices down. It's copper's been in a range for the last 18 months or so. It's like all these things can happen. But it just it may take time. It's like look at uranium. Uranium had a really strong demand supply story for a number of years, but nobody wanted to know about it. And then it over the last probably 3 years, 4 years, that's been building, but it's been a long time in the wilderness. Nickel, lithium, they could spend a decade doing nothing. I'm not predicting that's the case, but it could happen. It's not without precedent that a market goes completely out of favor. All the people screaming, saying, "You guys don't get it," they give up on it, they move somewhere else. That's when the base starts to complete and the new interest starts to come in and the new trend starts to bubble away. That's how these big trends often form. Like I think of gold back in the 1990s, nobody wanted to know about it. All the central banks were selling, and it bottomed, I think, in 1999, and then bottomed around 250. It's now at around 2,000. So it's but it took a decade in the wilderness for it to start to turn upwards. So yeah, great longer term stories with all these EV battery things, but yeah, the market knows, the market's pricing it. At the
Yeah.
moment, it's not, the market's not buying that story for whatever reason. I don't know what the reason is, but when it does, it'll be reflected in the price. The price will be above the moving averages. The moving averages will be moving higher, and that's telling you the path of least resistance is in switching. At the moment, fighting a downtrend, trying to pick the low, it's dangerous and it is often costly.
Yeah, it's maybe as you say, Dean, we are so far away from the sales force, where it's at, the sales versus the sales forecast, we're quite far away, right? So I think I heard a statistic, like there's still only 1% of EVs out there in the market on the roads today, right? So I think we're still far away from mass adoption, that's for sure. So, and the shares reflect that. Okay. One question completely off topic that was right at the start here, Jason. There's someone here that knows that you're a runner, and I know you're a runner, and I just started running this year as well, but I don't run as much as you do. I actually run with our friend Rob, who's behind the scenes and sets this up for us. We run in the office together sometimes in the mornings. But he wants to know, how far do you run each day?
Each day.
Yes.
Well, it depends what I'm doing. If it's sort of like a long, call it a long easy run or cardio run, base run, might be 15K or something like that. If it's shorter intervals, it might be 5K, but broken up into intervals. All might add up to about 50K a week. It's so yeah. Look, it's good. Keeps me fit. I still like to do competitions. I do masters competitions. Athletics New South Wales have a track season, which I do. I do some cross country in the winter. Hung up the marathon boots about 6-7 years ago. So I keep it shorter now. A couple of my kids run with them. They're quicker than me now. I've lost the family crown, and but all good fun.
So there's a lesson in this as well, I'm assuming, Jason, is that if you keep fit and healthy, you'll be a better trader. Is that right? A better investor, I should say.
Yeah, it's funny. I've had some of my best ideas when I've been out on a long easy run. Just the way your mind opens up when you're exercising. It doesn't have to be running. Maybe it's yoga or bike riding. Maybe not bike riding. Probably got to concentrate more on where you're going, or you can end up in bother. The advantage of running is a little bit slower, so you can your mind can drift when you're doing some slower stuff. It's just the great thing about activity. It can get your mind in a really good flow, and you do get ideas, and some of those ideas can be good ones.
I can attest to that for sure. All right. Thank you very much, everybody, for attending. Please like and subscribe and write a comment if you like. Don't forget that, we're at Selfwealth. You can get 10 free trades. If you're a new trader there, you can sign up down the bottom. You can visit Jason at Motion Trader and have a look at that article he showed us as well for free. For I think it's a 14-day trial. Is that right, Jason? Yeah. Thanks again this week, Jace. It's been a pleasure.
It's been good. Covered some good ground today. I think a few interesting things. And viewers, make sure you tell us what you're interested in. We can zero in a little bit more on that in the future.
For sure. And if you can do that even before we get to these days, right, we can plan a little bit more as well. So anything you want to learn about in this space as well, the technical analysis space, we'd love to hear from you via any of our support channels or even on this YouTube comment channel. Thank you, everybody. Have a great day, Jason, everybody behind the screens.
Good one. Thanks, everyone.
Take care.